Hello friends, we'll be discussing the concept of cost right now. Now, when it comes to the concept of cost, we'll be discussing what all types of cost do we have in or rather in the syllabus of production and cost, or rather the theory of production and cost here. So when we are talking about cost, we understand that there is an ISO cost line. Earlier we understood everything about the theory of production. Now we'll be discussing theory of cost completely. Now this theory will give you the basics details of what all cost you have to encounter, or what are the terminologies that will have to go through when it comes to cost concept of any economics. Now let us go to the theory part of it. Rather, let us just understand what is the definition of cost first and what exactly are the different kind of costs that we'll be dealing with. Now it says that before analyzing the cost concepts under short run and long run, some basic concepts needs to be discussed which do not change under short run and long run. So we have already assumed, or rather we have already known how short run cost and long run cost defines, or rather what exactly is short run cost and what exactly is long run cost here. Now before we go into the depth of this, or rather analyze more of short run and long run cost, there are certain basic concepts that you need to understand, whether or rather when you're supposed to use these concepts, how exactly these concepts work, and which all things they are related to or linked to. So let's understand those concepts first. Now the first cost that we'll be discussing is the accounting cost here. Now, accounting costs are the cash payments which a firm makes to other factor owners for purchasing and hiring for various factors of production. Now, accounting cost is basically the cash payment that a firm makes. Now, this payment either goes to other factors of production or other firms, basically from which goods are hired, from which services are hired, or other goods are purchased, and this is as a part of the factors of production, and this is basically the input. So basically, if you hire labor, you give out wages. Now if you hire capital, or rather there's an interest, if you take capital on loan here, there is an interest that you have to pay. If you pay rent on the land, that is again an accounting cost here that you have to take into consideration. So this is the basic definition of accounting cost here. It is also called as explicit cost. This is also known as explicit cost. Accounting cost, a different name for it, can be also termed as explicit cost here. Explicit cost refers to the kind of payment that you're making for specific purpose. Now, the rent is paid only for the land purchase, or rather land being hired. Do you pay rent for the wages, or rather do you pay rent for the labors here? No, you don't pay. You pay wages there. Hence, when explicitly that cost is maintained, or the cost is done for a specific purpose, that is known as an explicit cost, and that explicit cost can be called as an accounting cost here. When a business firm starts production of a good, firm must pay prices for the factors used in the production process. Now, this is also known as a working capital. You can say that if a business firm is producing certain goods, or rather providing certain services, there are certain equipments that are required by the firm, and the cost that is paid here while the production is still on is known as a production cost. So basically the cost that is paid while the things are still working out, while the production is still on, or rather while converting the raw material into a finished good, that whole process itself is known as a production process, and the cost is supposed to be paid there. Now, for instance, a firm pays wages to the laborers employed, prices for the raw material, rent for the place and building it hired for production, and the rate of interest on money borrowed for business. Just like the example that I gave you, the rent is paid for the land where the factory is set up. Wages is paid for the laborers who are employed in that factory to produce, or rather to convert the raw material into finished goods. Capital that is taken on that interest is paid, because money is borrowed in terms of capital and interest is supposed to be paid on that loan. Now the other part is where the wages, salary, etc. is provided to the entrepreneurship, profits are given to the entrepreneurship. Everything is accounting cost here. An accountant will consider all the direct payments made by the business firm. Now, whenever an accountant comes into the picture, he will consider all these costs, because all these costs are direct costs that are done to convert the raw material into finished goods. So whatever cost you're paying up for converting the raw material, for example, if this is a pencil, if this was not prepared like this earlier, there must be certain raw materials that must have incorporated or rather been taken together to prepare this one pencil as a whole. So the cost that you have bared while making, or rather while making this pencil, converting this raw material into a pencil like a finished good right now, you have to pay certain costs. So the accountant will take all these costs into consideration while making tax returns, or rather while making any kind of balance sheet, any kind of financial statements here. Now, the next cost that comes into the picture is economic cost. We dealt with accounting cost. The next one is economic cost. Now, what exactly is economic cost? How exactly the concept of cost has economic cost in its picture? Now, in addition to all these accounting costs, economic cost takes into account all the implicit costs which the entrepreneur could have earned if he would have invested his own money and sold his own services in the next best alternative uses. Let me read the line for you once again, because I'm pretty sure this must have been a very confusing line for you. Let me translate that in a simple word, or rather simple lines for you. Now, apart from all the accounting cost, what all they are trying to say is that apart from all the accounting cost, there is one cost that we have to discuss about, and that is economic cost. Now, what is economic cost? Economic cost is all the implicit cost which the entrepreneur could have earned. It's like an opportunity here if he would have invested his own money and sold his own services in the next best alternative uses. So economic cost is nothing but just similar to the opportunity cost. For example, if you have this kind of pencil, you must have invested certain amount of money in this pencil. That means in making this product. Imagine if this amount of money that you had, if you had invested the same money in something else, or rather selling your own services, rather the next big alternative, or rather the next best alternative. This was the best alternative for you. The second best alternative, if you're paying up money for that specific service, now that cost is known as economic cost here. For instance, if an entrepreneur invests his certain amount of money in his own business, would have invested somewhere else, then he would have earned certain amount of rate of interest or dividends. Now, for example, you had 10,000 rupees. You invested all that 10,000 in this raw material, or converting the raw material into finished goods like this. For example, if you would have invested that 10,000 amount into certain shares, into certain stocks, which are at risk for sure, but while this is happening, you must have earned certain additional money. Here you are not earning money. Here it is a risk completely whether the product will be sold or not. But there you might have certain less risk as compared to, okay, yeah, you're receiving these dividends, you're investing 10,000, you might have earned around 12,000, which is for sure. You might have not earned around 18,000, you might have not earned around 20,000, but you must have earned around 12,000, which was for a sure shot income. But when it comes to like these investments where you're selling out products, where you're selling out services, it completely depends on how this product works in the market. Hence, that cost is known as economic cost. Why economic? Is because you're taking a smart decision, you're taking a calculated decision. So when there's a calculated cost, that means that there is a sure shot income source that can be done, and hence it is termed as economic. Economy itself is known as making a planned decision here, hence economic cost. Similarly, instead of working in his own business, if he would have rendered his managerial and entrepreneurial services somewhere else, he would have earned some amount of money. Now, again, economic cost would also deal with, for example, if you're running your own business, rather instead of working for your own business, if you would have invested that much of time in some managerial job, or rather selling out your entrepreneurial services to some other company, you must have earned per month basis, or rather there is a sure shot income again. Why? Is because it will be termed as a salary that you're getting, and salary won't be delayed. Hence, salary is something that you will earn by default, by hook or crook, every month, and hence that is known as an economic cost or implicit cost. Thus, economics include all these costs as implicit costs. The word implicit cost itself is termed as implied. You're working, you're implied to receive money. Explicit means if this product works, then you will receive money. Implicit means you're working and you'll definitely receive the money. So there is a thin line between definitely or you will. So that's the grammatical mistake, or rather that's the grammatical mistake most of the common students do. That's the most common error that we figure out when understanding such terms or such terminologies and comparing them when it comes to economics. Now, this is an implicit cost in the cost of production. So basically, whenever you're talking about economic cost, it is an economic implied cost in the cost of production here. Hence, economic cost take into account both direct and indirect cost. Here you can understand that economic cost takes into picture both direct and indirect cost, which is supposed to be done here. Now, economic cost, the formula here is accounting cost plus implicit cost. Accounting itself is direct, implicit will be indirect. So this is direct plus indirect, that is accounting cost plus implicit cost here will give you a formula for economic cost. Now we come to the next picture, or rather we come to the next topic, which is known as opportunity cost. Now what exactly is opportunity cost? Let me give you a brief idea about it. For example, if you're buying a car, all right, you're buying a car, you have a budget of around 4 lakh rupees. This 4 lakh rupees, you can buy two things. One, that is, you can buy a car which will be completely paid off, which will be yours. Okay, the budget is low, so 4 lakh is fine. 4 lakh means you'll get the complete car here. The next thing that you can do is that invest that 4 lakh into some shares, into some securities, and wait for like good year or two, and then see that the money is getting doubled or multiplied with certain factors, certain rate of interest being adding up to it. Now this 4 lakh can either turn into 6 lakh, can either turn into 5 lakh, or either can go down. It is a completely market risk. This is one option. So 4 lakhs that you're investing in the car value is going to go down after 2 years. Here, the value of your money may shoot up. I'm saying may. It may or may not happen. Hence, may shoot up if you invest that in stocks. Third option I can give you is you can invest that 4 lakh as a down payment for buying some flat, for buying some room. All right, now once that is done, of course the budget is high, so this will be just counted as a down payment towards your flat. But if you buy that room, if you buy that house, you might rent it to someone and you can earn money and pay off the EMIs here. Now out of all these three options, which one can you select, or which one will you select? I personally would select the option, or rather the third option, where I have to buy a flat, because I have my own reasons. One, I have a property of my own for near future. I don't have to pay the EMIs because I have a rent that is coming in, and that will help me paying up the EMIs here. Next, after a few years, or rather after 10 years, the property will be mine and the property value will be appreciated. So whatever value the property I had taken in, it may be for 20 lakhs and I'm paying 4 lakhs as a down payment. But after 10 years, the property cost of that property, or rather the cost of that property, will go from 20 lakhs to 1 crore. Hence, that is an appreciation here. Same with the shares and stock, but there is a complete market risk. You have to keep on looking into whether it will go or not. You have to take active decisions. I am not very fine with that. Hence, I would choose the third option. People who are very active with the shares and listings, everything, who are very familiar with the stock markets, they know how to roll the money there. Hence, they will go into that option there and convert that thing. If you don't want to wait for good next 10 years, if you want that to be converted within 2 years or 3 years, maybe you can select that option. And people who are absolutely enthusiastic about cars, they will go for the option one, because they know that they have selected this money, or rather they have saved this money only for this car. So that's an explicit cost. But at all, or rather if at all you didn't invest that money in that cost, then you lost an opportunity. Or rather, if you're investing that money in the car itself, you lost two opportunities here. One, of the shares in stock. Second, of the flat. Hence, that money is known as opportunity cost. If you have selected the second one, you lost the opportunity for the third one, which is buying a flat. This is again a long-term investment, long-term thing that you have to pick into picture, or rather that you have to get into the picture here. That kind of cost is known as opportunity cost here. Let's read the theory of it. Opportunity cost is the cost of any next best alternative use that is sacrificed. So basically, A option, B option, and C option. I gave you three options together. You invested in A, you lost the next best opportunity, that is B. You lost the next best opportunity, that is C. You invested in B, you lost the next best opportunity, that is C. You invested in C, you must have lost some other opportunity that you might have encountered had you been exploring that thing, or rather had you been exploring that option in the first place. So there are a lot of opportunity costs, and that will keep on going. You just have to select the best practice, or rather you have to just select the best option which is as per your requirement, and that can give you healthy repaying for your money here that you're investing. Now, suppose a piece of land can be used to grow both wheat and gram. That's an example. If the farmer uses a piece of land only to grow wheat, then he sacrifices the production of gram. It's a very simple example. You have a piece of land whereby you can grow both wheat and gram, but the farmer decides that he will only go with wheat here. So he lost the opportunity of growing gram. Had it been done, or rather, had he would have invested that money in growing both wheat and gram, whatever price wheat was fetching, or rather, if wheat is fetching around 100 kilos, or rather 100 per kilo, and gram is fetching around 120, you could have opted for both these things, or rather you could have just grown gram. That would be again a loss of opportunity cost. But if you're growing both of it, because the land is suitable for both of those production, you would have earned the benefit of wheat as well as the benefit of gram here. Hence the opportunity cost that you lost here is the growth of gram. Now, opportunity cost for a firm of using resources in the production of one good is a revenue foregone by not using the resources in the next best alternative. So, for a firm, when we're talking about you're investing something in one, that means that amount is locked there, that amount is fixed there, and it cannot be used for the next best alternative, which could have given you much better results, or rather, which could have given you certain results as well. So, once the amount is blocked into something, you are losing out certain opportunities there. Now, suppose the factors of production which may, or rather which a firm used to produce good X may also be used to produce good Y. Here, what they're talking about is that the productions, or rather the factors of production that is produced, or rather that is used here to produce good X, can be also used to produce good Y. Here, there's an opportunity cost, because with the one same factor of production, you can prepare goods X also and goods Y also. Thus, the opportunity cost of production of good X is the foregone revenue which a firm would have earned if the production of good Y was done. So, if you're only using that factor of production for the production of good X only, that means you're losing out on the production of good Y, which is again an opportunity cost that you have just lost here. Now, the next cost that we have into the picture is the private cost. Private cost is a cost made by a firm for manufacturing a commodity. Private cost is the cost that a firm expenses, or rather makes into the picture. Why? Is because it wants to manufacture a certain commodity. Now, it is the sum of both explicit cost and implicit cost, as a business firm considers all these costs while making both production decision and decision about prices of the product it has manufactured. So basically, if you're manufacturing something, you're manufacturing a product. Now this product will have both explicit cost and implicit cost, and a firm will take the summation, or rather the total of both these costs, to make two decisions. One, the production cost, to determine what is the production cost here, and second, what should be the selling price, because you need to know that whatever cost you have incurred in making this specific product, you need to recover that, and apart from that, you need to also earn profit so that the firm can keep on running and it can make profits in the near future that will help in expansion of this business itself. Hence, private cost is a comparison, or rather total of explicit cost and implicit cost, which is direct and indirect cost. You can also call it as accounting and implicit cost, or rather accounting cost and implicit cost here. Next one is the social cost. What exactly is social cost? Let us understand that. It is the cost to the society of an economic activity. It is the cost to the society for an economic activity. We'll have to learn more about this. In other words, social cost is the sum of private cost and the net of negative externalities over positive externalities. Social cost is nothing but it's the cost whereby you deduct, or rather it is the sum of private cost, total of private cost, or rather if I have to give you a specification related to this, let me just write it down in some different ink. Now this will be private cost with the total of negative minus positive externalities. That means negative minus positive, whatever balance is left, that is added in this cost. Now this will be your total cost, or rather social cost. Social cost is the total of private plus negative externalities minus positive externalities. Now the production of a commodity caused benefits and some loss to the society, including the depletion of, or rather depletion of air quality due to high pollution and other negative externalities generated by the manufacturing for the locality or the firm or the society. Now if you're setting up a factory, of course that factory is giving out certain waste, certain chemicals that run out of the factory. It may be the smoke pollution, it may be the water pollution, whatever exactly it is. So with the production that you're doing, you're also setting, or rather you're also damaging the society. Now you have to bear that cost. You have to take into consideration how exactly that is damaging the society and how exactly you need to run a product, or rather you need to run something whereby you can help yourself with that specific thing, or rather you can minimize the damage to the society or to the locality of that specific area whereby your factory is completely set up. Now, let's take an example. A manufacturing firm does not consider these costs while making decisions regarding the prices and output of the product. So, whenever a manufacturing concern has to make certain products, these certain products, or rather the pricing of these products, won't include the social cost in that thing, because that's a damage that a company is doing willingly so that it can manufacture certain goods. Hence, if they add that cost and they recover it from the public, it will be a completely vague decision. Why? Is because you are anyway damaging the society which is belonging to the public, and you're still taking money from them for that same damage that you have created. Hence, social cost is not included in the pricing of the product here. These externalities caused by the production of a firm to other constitute a part of social cost, which a business firm completely ignores in any business decision, but may be greater significance from the social point of view. As a firm, I will completely ignore this thing. I won't even consider this cost as a part of the selling price. Why? Is because this cannot be done. But from a society point of view, this cost is very important, is because the company has to pay for the damages that is done to the nature, that is done to the climate, because of the manufacturing of such goods which emits out certain pollutions. That may be the toxic pollutions in terms of water pollution, it may be in the air pollution, it may be the sound pollution. Anything can be done. Now for instance, a pesticide producing firm, a pesticide, that's a chemical, creates some negative externalities while producing pesticides, which includes foul smell, that is one thing, polluted air because there is smoke emission, effluents that are emitted as a part of the production of pesticide. You are producing a chemical, of course there will be byproducts here, there will be effluents here, there will be water pollution, there will be smoke pollution, there will be air pollution, everything will be there. But that pesticide is needed so that you can keep insects, termites, etc. out of your house. That is again for your safety. But from a society point of view, you're securing your house, but the outside area, the climate is getting damaged because of this. Now these caused economics damages to the society in various forms, including health problems to the people who live in the adjoining area. So wherever, if you see now, today in Delhi or today in Bombay, today if you look in your country itself, there's a lot of air pollution. Why? Is because there are no trees. First of all, the trees are getting cut everywhere. You see deforestation happening, you see more of technical infrastructure advancement that is happening. Now because of these things, you see that the nature itself is declining, the forest cover is completely declining. Hence it is causing a lot of health problems, or lot of problems for the people who are in the vicinity of that specific area where the factory is set up. That is causing a lot of problem. Those are the major people who get affected there, and then after comes the background people who stay there, or rather who stay in that locality here. Now these harmful effects are known as negative externalities. So whatever negative externalities are there, the harmful effects itself are termed as negative externalities here. Now the beneficial effect caused by the production of commodity are known as positive externalities. Now whatever benefits you get from preparing the pesticide, from preparing something else, like the metro is being created in our country. With this metro, the benefits that you'll be getting is, first, that the travel will be very easy, there will be less congestion on the roads because of the traffic. The negative externalities will be that the construction is taking a lot of time, it is creating a lot of traffic, it is creating a lot of smoke here, lot of dust, and that is creating a damage to the social environment here, or rather we can talk about the climate changes that are happening here. Now when the negative externalities and the positive externalities are taken together, you need to see the net effect of this. If the negative effect is much as compared to the positive effect, the total net result will be negative. But if the negative effect is lower as compared to the positive externalities, that means there's a positive growth here, and that can be added to the causative, or rather the private cost, which will give you a social cost total. So social cost equals to private cost plus the total of, or rather net of, negative and positive externalities. So in this cost concept, whatever you have understood the accounting concept, you have understood the economic concept, the opportunity cost, the private cost, and the social cost. So these are the kind of costs that you have to understand, and you should be able to explain that in a better way with some real life examples for sure. So this is all that we have when it comes to concept of cost. Thank you.